Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. It is March 10th with the Moose, John Mousseau, Director of Fixed Income, CEO at Cumberland. What a difference a week makes. Last Friday, I said, we got a little bit of a bid in the equity markets Thursday and Friday. Maybe it can get our feet under us there. I was actually looking at cash balances to maybe put to work. Didn't.
Right.
So there's always good news and bad news. The good news is banks aren't a big part of our allocation. The bad news is we do have a little slice of Schwab, which got pulled into that vicious beating. We did, in some accounts, nibble on a little bit before the close, by the way. If you remember last year, John, we did the same thing with Berkshire Hathaway when it got 140% oversold on the weekly. That's a number that, you've heard me say this before, I shut my eyes and hold my nose and buy. Now, this is a little bit different because you do have a bit of a panic going on.
Right.
So we'll see what happens. It's not unlike some of that fear you saw in 2008. Just different situation in terms of balance sheets. But, you're talking, you remember yourself on Fridays, you'd go home and you didn't know if Citibank was going to open on Monday.
That was the day. You're not at that point yet. But when you have a week like this where, you have the SVB Bank, failed this today, and you go back earlier and you had an earlier bank failure in the month. There's singular small situations, but the market tends to focus on those. They don't know if it's a canary in the coal mine. You saw the reaction today, partly because of that, partly because in the jobs number, which was a good jobs number at 311, better than expected, but within there, also, wage growth was lower than expected.
A little bit of softening.
So a little bit of softening, and the market took that. So between the bad news in the banks and the better news on wage inflation, bonds were up 2 points today, and shorter-term yields were down 25 basis points for the week, and 10-year bonds were down 25 basis points for the week. Just a dropping of yields in general. And
well, the Fed in some way benefits from what we saw in the bank action the last 2 days, because it's difficult to think, having traded the markets for as long as you have and for the span that I have, that banks coming off a week like this are going to be loan hungry and aggressive.
Right.
And when banks pull back in, inflation tends to start to fall.
Correct.
Again, that will be at the edges first. The regionals, which are, primarily the small banks and regional banks, they're primarily loan banks. They're old-time loan banks. They're not money center banks, like JP Morgan, who was actually up today, where they make money in multiple ways: trading, managing accounts, asset management. There's
currencies,
multiple ways. It's, not unlike Schwab, by the way. Multiple phases to that business. Very different than Silicon Valley Bank, who had at one point, I believe it was 50% of their clients were venture capital private equity clients. Now we know,
tells you all you need to know,
when tech was as weak as it was last year, and some of these emerging companies start to burn through their cash, burn through that cash that they raised, and start pulling money from the banks, you start getting that liquidity problem. Now, SVB, Silicon Valley Bank, to create enough liquidity to service their clients, they had to be bond sellers.
Correct.
Now, not to go in a deep dive, but banks are treated a little bit differently in terms of pricing on their bonds.
Right, and I think the important part there is good bonds, government bonds, agency bonds, but bonds that have been underwater.
Right.
And they don't have to mark them to market, so they don't realize those losses until, of course, they sell them. And if they have to sell them to raise cash, that's what starts to put a squeeze down on their balance sheets.
Right. So you saw a little old-fashioned run on a bank.
Correct.
Didn't trade today. They'll look for a buyout. We'll see what happens. The main thing is to see where that contagion is.
Absolutely.
There were a handful of banks that traded in sympathy there. And some areas of the market, by the way, traded okay today. So I'm not trying to paint a broad brush, but for as long as we've been doing these videos, which is over 3 years, almost 4 years now, John, anytime the markets are in tricky or tough situation, I talk about banks.
Right.
And as long as the banks are solid, I can breathe a little bit. When the banks start to fade, and this goes back to 07, you know, and the banks, if you go back, if you were trading in 07, if you're managing money in 07, if you want to go back to some charts and pull some headlines and comments, the banks rolled over in May of 07.
Yeah, and kept rolling over.
And never could get their feet even under them. Even when the S&P rallied Q4 of 07,
right.
Banks really didn't rally. And that was really, the canary in the coal mine.
Sure was.
So here, is this a 1, 2 off, 3 off situation, or are we looking at the beginning of some headaches where we have to rein in risk more, pull in risk more, and tighten down the hatches?
Well, and you wonder whether it also gives the Fed, this kind of action gives the Fed a moment to maybe think about pausing, maybe not now, but down the road. You know, we have an important CPI number next week. That'll set the stage a little bit for the Fed, but I can guarantee you, even though they're probably not meeting this weekend, the Fed, they're probably talking by phone.
Oh, they're having conversations,
for sure.
No doubt. So in terms of going into next week, listen, there's some things that leave us in pretty good shape. And, I've been going over it, and some people, they send a comment and say, that sounds high, your cash levels and call. And in our U.S. ETF strategy, we're almost 36, 37% cash. In our tactical strategy, when you figure in the T-bills, about 25% cash. In our U.S. core strategy, we're about 15% cash. International, which has really hung in pretty well,
sure.
We're about 10% cash. So we do have cash to put to work. One thing we know, and we don't know if it's next week, next month, I said it all of 22, right? Or next year, there will be some phenomenal trading opportunities.
Always are.
We just have to have the capital available.
You bet.
Well, don't forget to like, comment, and subscribe so you can follow along with our weekly videos. What that also does is allow you to get our alerts. And with markets in this kind of situation, I wouldn't be surprised if we had to shoot something out next week. Have a nice weekend.